The accounting equation, learning objective. Demonstrate how certain business transactions affect the elements of the accounting equation. Assets equal liabilities plus owner's equity. Business transactions result in changes in the three elements of the basic accounting equation. A transaction that increases total assets must also increase total liabilities and owner's equity. Similarly, a transaction that decreases total assets must simultaneously decrease total liabilities and owner's equity. Some transactions increase one asset and reduce another. Regardless of the nature of the specific transaction, the accounting equation must always stay in balance. A fundamental characteristic of every statement of financial position is that the total for assets always equals the total of liabilities plus owner's equity. This agreement or balance of total assets with the total of liabilities and owner's equity is the reason for calling this financial statement a balance sheet. But why do total assets equal the total of liabilities and owner's equity? The dollar totals on the two sides of the balance sheet are always equal because they represent two views of the same business. The listing of assets shows us what things the business owns. The listing of liabilities and owner's equity tells us who supplied these resources to the business and how much each group supplied. Everything that a business owns has been supplied to it either by creditors or by the owners. Therefore, the total claims of the creditors plus the claims of the owners always equal the total assets of the business. The equality of the assets on the one hand and the claims of the creditors and the owners on the other hand is expressed in the following accounting equation. Assets equal liabilities plus owner's equity. $360,000 equals $96,000 plus $264,000. Every business transaction, no matter how simple or how complex, can be expressed in terms of its effect on the accounting equation. A thorough understanding of the equation and some practice in using it are essential to the student of accounting. Regardless of whether a business grows or contracts, the equality between the assets and the claims on the assets is always maintained. Any increase in the amount of total assets is necessarily accompanied by an equal increase on the other side of the equation. That is, by an increase in either the liabilities or the owner's equity. Any decrease in total assets is necessarily accompanied by a corresponding decrease in liabilities or owner's equity. The continuing equality of the two sides of the accounting equation can best be illustrated by taking a new business as an example and observing the effects of various transactions. How does a statement of financial position come about? What has occurred in the past for it to exist at any point in time? The statement of financial position is a picture of the results of past business transactions that has been captured by the company's information system and organized into a concise financial description of where the company stands at a point in time. The specific items and dollar amounts are the direct results of the transactions in which the company has engaged. McBrien officially started overnight on January 20, 2018. On that day, he received a charter from the state to begin a small, closely held corporation whose owners consisted of himself and several family members. Capital stock issued to these investors included 8,000 shares at $10 per share. McBrien opened a bank account in the name of Overnight Auto Service, into which he deposited the $80,000 received from the issuance of the capital stock. The cash account of Overnight Auto Service increased by $80,000, and the capital stock of the company also increased by $80,000. Notice that the basic accounting equation is in balance. Total assets are equal to total liabilities plus owner's equity. On January 21st, Overnight purchased the land from the city for $52,000 cash. Let's see how the balance sheet looks now. The cash account has been reduced by the $52,000 spent, and the land account has been increased by the same amount. One asset, cash, was merely traded for another, the land. Owner's equity is not changed by the transaction, and the basic accounting equation is still in balance. On January 22nd, Overnight purchased the old garage building from Metropolitan Transit Authority for $36,000. Overnight made a cash down payment of $6,000 and issued a 90-day non-interest-bearing note payable for the $30,000 balance owed. Let's update the balance sheet. The cash account decreased by $6,000, and the building account increased by $36,000. There was a net increase in the asset side of the equation of $30,000. The liability account, notes payable, increased by $30,000. Total assets are now equal to $110,000. Total liabilities are equal to $30,000, and owner's equity is equal to $80,000. The accounting equation is still in balance. On January 23rd, Overnight purchased tools and automotive repair equipment from Snappy Tools. The purchase was for $13,800 due within 60 days. Let's update the balance sheet. The tools and equipment account increased by $13,800, and the liability account, accounts payable, increased by the same amount. The balance sheet is getting progressively more complicated. After taking delivery of the new tools and equipment, Overnight found that it had purchased more than it needed. Ace Towing, a neighboring business, offered to buy the excess items. On January 24th, Overnight sold some of its new tools to Ace for $1,800, a price equal to Overnight's cost. Ace made no down payment but agreed to pay the amount due within 45 days. Can you update the balance sheet? Try before proceeding to the next slide. The asset account, tools and equipment, decreased by $1,800, and the asset account, accounts receivable, increased by the same amount. Once again, one asset, tools and equipment, has been exchanged for another asset, accounts receivable. How did you do? On January 26th, Overnight received $600 from Ace Towing as partial settlement of its account receivable from Ace. Let's prepare the updated balance sheet on January 26th. The cash account increases by $600, and accounts receivable decreases by the same amount. Notice that total assets are still equal to total liabilities plus owner's equity. On January 27th, Overnight made a partial payment of $6,800 on its account payable to Snappy Tools. It's time to update the balance sheet. The cash account decreases by $150, and accounts payable also decreases by $150. The total assets are now recorded at $117,000. Total liabilities plus owner's equity is equal to the same amount. On January 31st, Overnight recorded auto repair services provided for the last week of January of $2,200 received in cash. Try updating the balance sheet before moving to the next slide. Be careful with this one. The cash account increases by $2,200 and retained earnings increases by the same amount. The monies received represent earnings of the company that have been retained. The $2,200 represents revenue earned by the business. How did you do? In the final transaction on January 31st, Overnight had to pay some operating expenses, namely $200 for utilities and $1,200 for wages. Let's make the final update to the balance sheet on January 31st. The cash account decreased by $1,400, and so did the retained earnings of the company. Overnight used $1,400 of its earnings to pay for expenses. Now, let's review how Overnight's transactions affected the accounting equation.